market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. So geopolitics and tech definitely dominating the news agenda again. The U.S. and Iran have exchanged fire again, and we'll have the latest in just a moment. Meanwhile, traders await today's, of course, U.S. CPI numbers. Out in a few hours, we discuss all of this with BlackRock's Vasiliki Pachatouridi and our very own Simon Kennedy shortly. But first, let's continue our coverage of SpaceX's upcoming IPO. Concerns are being raised about the potential impact of sharp demand for the company's shares from index tracking funds. Well, we're now joined by our Bloomberg senior strategist, Neil Camping, who's been really looking at tech very closely. Neil, thank you for joining us. So what exactly are the worries?
Morning, Van. It's the question that's being discussed is potentially that the passive funds will inflate, if you like, perhaps to a degree artificially, the appetite for this particular offering. And of course, once the passive funds are then positioned into the stock, then where is the follow-up demand thereafter? Passive funds clearly are a very big determinant. I mean, we know that in certain instances, passives for certain funds are twice as big in terms of overall valuations relative to active funds. The key things to look out for in the next 24, 48 hours are messages around how many times oversubscribed the deal is. Speaking to an IPO specialist recently, suggesting to me that if we hear multiple times oversubscribed, that's low numbers of oversubscription. If they talk about 10, 20, 30x, then we know that there's a lot of appetite from retail, from institutions, active and passive funds. So we'll have to keep a close eye on the words used in press releases, press reports in the next 2 days.
So interesting. It's like central bank watch. Every word matters. So meanwhile, Anthropic is also set to release basically its latest mythos. Do you say mythos or mathos? I say mythos, but I don't know the Greek way. Models. How are these different and new?
So the new models are basically the ones that we had in beta form earlier, and they were not available for public use because of the cybersecurity issues. The issues were they found that sort of other technologies couldn't find flaws in existing models for 40 years. They found them in a matter of minutes. What they're releasing now is products into the market. They've used examples where they can do a task in 1 day that has taken a group of engineers 2 months to do in the past. This is accelerating products to market, brings in revenue, and clearly is trying to widen the gap in terms of the revenue model versus rival OpenAI.
Neil, thank you so much. Neil Camping there with the very latest on some of the tech stories. Now, the U.S. launched strikes against Iran yesterday after President Trump blamed Tehran for shooting down an American military helicopter off the coast of Oman. Now, the U.S. Central Command described the operation as, quote, proportional response, suggesting that Washington was seeking to contain the confrontation rather than resume full-scale hostilities. Well, according to Iranian state-run media, Tehran later hit several U.S. targets across the region. So let's get the latest from Abir Abu Omar. Abir, what is the latest exactly on the ground?
Good morning, Francine. So look, some retaliation that has happened this morning from the Iranian side. This is after President Trump told ABC News yesterday that he will hit Iran in a powerful way because of what happened on the day prior, which is when Iran had downed an American helicopter. The crew members were safe, so they ejected. President Trump had said that the red line for him to return back to hostilities would be the death of American troops on the ground. Now, that did not happen, but he felt the need to respond. So the Iranian retaliation came this morning in the shape of attacks against some U.S. bases in the GCC. That includes Bahrain. The U.S. Fifth Fleet was attacked. Kuwait as well had a U.S. base attacked. And then we also saw attacks in Jordan. Iran, on its side, said it will not sit idle in the face of these American hostilities. But for the time being, it looks like the attacks on both sides have stopped. Meanwhile, President Trump did say that the truce talks are ongoing. Our own sources do confirm to us that the truce negotiations are intensely being held, with Pakistan still mediating. Now, we've been hearing this we've heard this a lot of times over the past few months, Francine. But for the time being, again, President Trump seems to be intent on getting this truce, or the MOU, as we've been calling it, that would reopen the Strait of Hormuz and extend the ongoing ceasefire, if we're still calling it that, for the next 60 days or so.
Yes, but where does it leave the peace talks?
So yes, look, they're still ongoing according to our sources, according to President Trump. Again, he's mentioned over the past couple of months that he wants to get this deal across the line. He's getting a lot of pressure internally as well with those polling numbers coming in, and also the elections coming up in November, the midterm elections coming up in November. So he seems intent on getting a deal down the line. Now, there are some concessions that are left on the table. Lebanon, for example, sticking as the last concession point for the Iranians that are adamant on not getting back to the negotiation tables unless Lebanon is stopped, unless Israel stops attacking Lebanon. Now, Israel does have its deepest incursion in Lebanon over the southern part of Lebanon for the past 25 years. Israeli Prime Minister Benjamin Netanyahu saying he will not stop those hostilities because he's seeing Hezbollah attacking the northern part of Israel. Israel is adamant on protecting itself against the Iran-backed militia in Lebanon. So look, the concession points are still very much on the table. We still haven't talked about the highly enriched uranium, the frozen assets, $24 billion of those, and also the oil sanctions that Iran wants to get through the line again. So those will come at a later stage, but for now, the MOU or the interim deal negotiations, according to the American side, according to our own sources, are still very much on the table, Francine.
Abir, thank you so much. Abir Abu Omar. Now, for more on the markets, we're joined by Vasiliki Pachatouridi, EMEA head of iShares fixed income product strategy at BlackRock, and Simon Kennedy, our very own senior executive editor for macro markets. He lives and breathes markets. So thank you both for joining us. Vasiliki, I mean, overall, look, we're expecting a CPI print in the U.S. It's unclear how central banks deal with inflation, but it's very likely that inflation is going up in the U.S. given the jobs report on Friday.
Yeah, absolutely. I mean, in general, we've seen a bit of a shift across central banks, both here in Europe, in the UK, and in the US, a more hawkish tone. We have a lot of meetings coming up. I would say that the message has to be one of patience and nuance. Yes, definitely, I can see the hawkish tone being validated to an extent, but policy is already tight to an extent. We know inflation is not purely demand-driven, it's supply-driven, and then the transmission mechanism from rate hikes is uneven. It doesn't hit necessarily the places where inflation is coming from. It's hitting the real economy first. But having said that, I do think that the case for owning bonds remains strong, and we do see that from bond ETF flows having had a record month last month in May. So there's still a lot of demand for income, resilience, diversification coming through from investors.
Sam, what are you looking out for in the next 24 hours? And one of we have brilliant pieces on Bloomberg, but one of my favorites was basically, if you look at the Treasury market, it's kind of telling the Fed they really need to hike.
Yeah, so if you look in the US 2-year, and we had this story yesterday, we've touched on it again this morning in the positioning, is that the 2-year yield is suggesting that the Fed is not restrictive, and therefore the message to Kevin Warsh as he takes over at the Fed is that at some point rates are going to have to be hiked. If you look at other parts of the market, they're looking at a series of hikes. Mark Cudmore talking earlier on Bloomberg about how either they'll hold or they'll do several. You can't just go one and done really in this kind of instance. So that's what markets are on guard for. And in the next 24 hours, the next few hours, as you say, US CPI coming up. And that's a really big, above 4%. That's a really big number. And it's starting to, since that jobs report on Friday came in strong, people have tuned into this. There's definitely a sense that this is a big report than perhaps it was a week ago.
Do you think, could it be one and done?
I mean, we know that the Fed doesn't move in such singular ways. But again, I just don't think that we're going to see a Fed that is going to rush into it. Obviously, we're now in blackout period. Next week is also going to be the first meeting that we're going to see the new chair coming through. So I also think the next couple of Fed meetings are also going to be communication tests that will shape market expectations when it comes to the new composition of the Fed and the new chair.
So, what does it mean in terms of where you want to be positioned inflation, for example, even in European bonds compared to treasuries?
Yeah, absolutely. As I said, I mean, we've seen record flows into bond ETFs. So again, taking a couple of cues from what investors are really doing. A couple of things. Core exposures, they do definitely stay on the short to intermediate part of the curve. People want to earn income, but they don't want to take big durational bets. I don't blame them for that. Cash is kind of increasingly being seen as a source of return. The front-end rates are very elevated. And we are starting to see some re-risking in parts of the credit market and also emerging market debt. But again, investors are focusing very much on the carry as opposed to the idea of spread compression, which we know spreads are very tight right now.
Simon, when you look at the big driver in U.S. economics, I mean, how much of it is actually AI? So the idea that, equities are supported, people feel richer, they spend, and that's fueling inflation, but also growth after that blowout jobs report on Friday.
So, yeah, the recent debate is that maybe AI is more inflationary in the short term. The dream that Kevin Walsh has talked about a bit, that AI being this productivity miracle that we saw under Greenspan. It's going to take some time for that. While we're investing in data centers and the like, there's going to be inflationary. But certainly the wealth effect is a big one, and we see stocks continuing to go up. And certainly, we talk about the K-shaped economy. Certain elements of the American economy are feeling very happy about what they're seeing in their pensions, in their 401s and the like. And so that does lead into a kind of an inflationary environment, a spending environment, and one that kind of boosts inflation at the same time gives markets that long end we've just talked about some slight concerns.
Vasiliki, I mean, I guess two questions. On the back of that, we have a brilliant opinion piece by Clive Crook saying, let's count the ways that Kevin Walsh could disappoint and will disappoint Trump. But actually, my question to you is that if the Fed hikes maybe more aggressively than we had expected, what does that mean for Europe?
I think, the idea, like some of the more structural issues that central banks are facing, economies are facing, the developed market is facing, remain quite similar in the sense of like fiscal sustainability is something, it's a transatlantic phenomenon. So again, kind of Europe, we know that tomorrow is pretty much locked in. September is on the table for the ECB, but I just want to emphasize that, it's all about inflation. That's the primary kind of issue, the driving data point, but the indirect effect of inflation, the secondary market effect of inflation, they can take us up to the end of 2026 or early 2027. So timing has become uncertain as well, and markets don't like uncertainty. But on par, I would say we prefer duration in Europe over duration in the US, and we are even more cautious about longer duration from US Treasuries as opposed to European government bonds, which have been very well bid and very much in demand.
Is emerging market debt actually becoming more attractive in this kind of environment?
Yeah, I would say so. Again, selectively, we've seen emerging market debt, particularly local currency debt, performing really well. Like real yields remain quite elevated, and there are pockets. There are markets within that I would urge kind of investors to look that have different fundamental stories than the US and Europe. And a good example of that is Brazil. Obviously, real yields are the highest amongst all sovereigns, and also Brazil is the only economy, EM economy, that is expecting rates to go lower over the next 12 months. So again, the issue of diversification, we talk a lot about diversification from fixed income being challenged, but again, within fixed income there are pockets, areas of the market that people can diversify, and of course other asset classes that offer that as well.
And Simon, you and the team are, I know, looking at dollar. Is there anything else that we should be looking out for in the next couple of weeks?
Yeah, I think the interesting thing on the dollar, and ING was talking about that this morning, is that the big debasement trade that we were talking about a year ago has kind of been put on the back burner as people see the Fed talk about inflation, talk about the Fed raising rates. So there has been this kind of a little bit of a platform for the dollar. Whether it continues, whether we kind of get back into the US exceptionalism debate, remains something to be seen, but there's certainly some support there for the dollar from this environment.
All right, thank you both for joining us. A great way to get us started on this Wednesday morning. Vasiliki Pachatouridi, EMEA head of iShares fixed income product strategy at BlackRock, and our very own Simon Kennedy, Bloomberg's senior executive editor for macro markets. Coming up, private capital is in focus as the boom shows signs of faltering. We're live at the world's biggest private markets event for an interview with the Fortress co-chief executive. That's coming up next, and this is Bloomberg. Now, the private capital industry is convening in Berlin at an uncertain time following warnings of a credit market downturn and some significant write-downs. Redemption requests that were previously contained to U.S. private credit vehicles have spilled over to Europe. Well, let's head to SuperReturn, where Danny Berger has a great guest for us. Hi, Danny.
Francine, thank you so much. I'm so pleased to be here this year at SuperReturn with Jack Neumark. He is, of course, the co-CEO of Fortress Investment Group. Jack, wonderful to see you. Thank you for joining.
Thanks for having me on.
And look, this is an industry where I think there's a lot of contemplation as to whether the pain for credit right now is very much so just headline-driven, or if under the surface there's a real reconsideration that needs to happen. Fortress is interesting because you can often take advantage of other people's pain and maybe stress in the system. I just wonder, is there stress in the system at this point?
Yeah, so I think the way we think about it is that there's certain parts of the private credit market that are going to go through disruption. I think the software part of the market is the most obvious one right now. But when we look at credit more generally, there's a lot of sectors that are still performing really well. There's a lot of opportunities to go originate loans that we think are good risk-adjusted returns. But there are parts of the credit market that I think started to get a little bit toppy, and there may be some repercussions in those.
Well, what do
sectors.
Repercussions look like?
I think it's going to be lower recoveries, namely. I think there's going to be defaults in the software sector, but I think you really have to watch what those recoveries look like. And I think the severities in some of these software loans could be more extreme than what we've seen in the past. And for managers that over-concentrated in those sectors, that could obviously have an effect of having their underperformance be more material than it would be in other credit cycles.
It does feel like a lot of the conversation has been defending software and saying, look at our underlying portfolio companies. They're still performing healthy. I wonder if the reckoning has actually happened yet. Because, again, the conversation is there, but has the actual reckoning occurred of looking at some of these loans, which, again, defaults and recoveries are going to look poor?
Yeah, I think it's more the anticipation of what could happen at this point. I don't think you've necessarily seen a lot of these software companies get in a position where there's actual bankruptcies on the near-term horizon. But I think when you look at where some of them are heading, especially the 2020, 2021 vintage software loans, I think people are fairly highly confident that there's going to be defaults that come and that there's going to be some bad outcomes for those loans.
Do you think that has an overall effect on the industry itself? Maybe an icing over, especially for funds who were over-indexed to software? Does it have wider ramifications than just those individual performances themselves?
Yeah, I think in terms of future opportunities for certain managers, it could have an impact. I think when people think about credit, they want diversification, they want good portfolio management, and over the last 10 to 15 years, there hasn't been a big difference in managers, and you could over-concentrate your book, you could take certain risks, and it ultimately didn't show through in the returns because we had such a benign credit environment. I think now the world we're heading is going to be one where there's different return profiles for different credit managers, and some credit managers are going to have to justify the fact that they got over-concentrated in certain sectors.
It's interesting you talk about this because a lot of people have said it's time now for diversification. We learned that over-indexing to software was a mistake. What do you then make of some individual funds piling so heavily into AI and AI data centers? I know this is something specifically Fortress is not doing. So are you seeing something others aren't and staying away from this trade?
Yeah, look, I think that some of these data center trades are really compelling. If you look at the counterparty risk, they're incredibly high-quality counterparties. They have lots of access to capital. That can make you feel very good. I think from an equity perspective, investing in some of these AI opportunities are clearly important for your equity return profile. But I think as a credit manager, our view is you have to diversify. I would not over-concentrate in software. I would not over-concentrate in AI. I think you just see that as a credit manager, there's real risk you could have underperformance if you make too big of a bet on any sector. So I don't see anything coming with data centers that are problematic. But when we look at our portfolio, we have questions about residual value, and ultimately we just want to be more diversified across a series of sectors.
So it sounds like it's fair to say that this is not something you'll participate in, or is there some elements that maybe you're eyeing that if you get comfortable enough, maybe with the digital economy, Fortress might?
Yeah, we've definitely done a couple triple net lease transactions with data centers. I think we look at smaller size transactions. We think those may be more liquid if you ever need to try to sell the underlying real estate. So I think that's one thing we focus on. And then we look at the overall concentration in the book, and we want to keep it, relatively small as a percentage of our portfolio.
Well, I mean, you've seen, for example, banks have started also to become over-indexed to AI because of the bonds coming through the broadly syndicated loan market and some of the other deals. So they've started to sell SRTs, and some of of your peers have been interested by this trade. I wonder what you make of that, of buying exposure that way via what the banks are putting out.
Yeah, it's similar to the data center trade for us. We don't want to chase trends. We don't want to over-concentrate. If we think we can get excess yield by doing something that's more unique to Fortress, that's what we're going to lean into. And so for SRTs, a lot of the underlying exposure you can originate on your own, and you can control the structure. You can control what assets go into it. You're not going to be a passive, very high attachment point lender, which is effectively what you are in an SRT. I think if SRTs were trading at high teens yields, I might have a different answer than I do when they're trading at lower double-digit yields. So for us, we'd rather just try to go create that exposure on our own rather than be a passive, highly levered exposure to something someone else originated.
Where on the platform are you most excited about? Where are you seeing some of the biggest opportunities right now?
Yeah, I think real estate credit has been one that we've been really focused on. I mean, that trade has gotten a little bit more competitive over the last 6 to 12 months. But I think if you look at where we are in the real estate cycle, lending against real estate right now, you're lending at lower LTVs than you've ever lent against. You're getting paid for the risk, high single digit, sometimes low double digit unlevered yields, and you're doing it on cap rates that are sort of at the bottom of the cycle. And so you have a lot of cushion in your real estate credit investment, and you can still get leverage on those loans from the banks to generate high teens levered returns. And so for us, that seems like a really attractive way to get exposure to real estate without having to make a bet on rent growth or cap rate compression.
I was going to say, just on that, how big of a difference does it make if we start to see hikes instead of cuts in this rate cycle right now for real estate and otherwise? The ECB will be meeting this week. The Fed right now, bets are on markets that they'll have a hike this year instead of a cut. How big of a difference does that make?
Well, it's going to hit everything if you have higher rates for longer. I think it's a combination of interest rates, inflation, and watching the consumer that we're really focused on. I think that there's a lot of companies that already have a very little cushion on their cash flow, and so if you have higher rates for longer, you have a little bit of consumer pressure because there's an inflationary environment. That could have real ramifications and could be a trigger for more opportunity on the corporate side or the real estate side.
All right, Jack, just about out of time. Thank you so much for joining. Really wonderful to see you.
Great, thanks, Danny.
Hopefully see you back in New York sometime soon. Francine, that is Jack Neumark, co-CEO of Fortress Investment Group.
Danny, thank you so much. Great interview, as always. And we'll get back to Danny with plenty more from the SuperReturn conference in Berlin. Because up next, we have an interview with Victor Khosla, the founder and chief investment officer at Strategic Value Partners. That's coming up shortly. And this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. The U.S. and Iran trade fire after President Trump blames Tehran for shooting down a U.S. helicopter off the coast of Oman. The SpaceX IPO frenzy continues to build ahead of its debut on Friday. Analysts warn demand from index tracking funds could drive up shares even higher. Plus, U.S. inflation is set to jump after a hot jobs report, while bond traders price in multiple Fed hikes, with some seeing a move as soon as September. So back to SuperReturn in Berlin now, where much of the private capital industry's top brass is convening this week. Weighing, of course, on private credit is the impact of AI risks on investments in tech companies. Let's get back to Danny Berger, who has another great guest for us.
Francine, I do indeed, and that guest is Victor Khosla of Strategic Value Partners. Victor, thank you so much for joining. I just say, we were just talking about this. A lot of people love to talk about at SuperReturn that everything is okay and there are no issues. You often are more outspoken than most when there are pockets of stress, and you've warned of fat tails and maybe things are calm on the surface, but underneath the hood, not so much. Where do we stand in that at the moment? Are you seeing some still maybe red amber flags underneath the surface?
Yeah, we've got a real disconnect today, right? The economy's okay. credit spreads at the headline level are tight, right? And then at the same time, what you have is you've got higher default rates. There are entire sectors, Danny, like private equity, like real estate, which are constipated, right? They can't sell. Private credit just joined the party a little bit too. So I think it's fair to say that there's a lot of stuff going right. I think on balance, it's also fair to say, my God, there are lots of the canaries in the coal mines are telling you a bunch of stuff.
That has to be an issue, though, because this industry needs to be exiting, right? That's the promise you give to your LPs. Well, what has gone wrong in that we got to this point, that year after year of LPs saying we want our money back, and we're still not at that point?
You know, when trillions and trillions of dollars of deals were done before the hike in interest rates in 2022, right? So 0% rates, people did all these deals. Rates are no longer zero. You've got valuation multiples are no longer what they were. For a lot of these businesses, you've got a problem. Now, add to that just more zip, right? You have a software shock running through. 20% of software debt is valued, priced below 80 cents, suggesting distress. That much distress in software. There's an oil and gas shock, which is starting to reverberate through. Interest rates are starting to go up. So trillions of dollars of deals, interest rates changed, and now you've got these, it's amplified by these shocks, and that's the problem. You've got to find clearing levels for these assets if you want to sell, and the clearing levels are not what people thought they would be, should be.
Can I just go back? You mentioned within some of that there's a canary in the coal mine. Is that just the stuck assets or the canary in the coal mine, and what does that indicate to you?
No, to us, the canary is really when assets are stuck. Assets are stuck because people can't get the price they think those assets deserve, right? Assets are stuck when you have a line of redemptions and you can't meet the redemptions and you have to gate, right? Those are very obvious canaries in the coal mine telling you there are lots of problems underneath this unruffled extent.
I guess also what I'm trying to get at is if there are canaries in the coal mine, what does it lead to? Like, what is the big disruption if at the moment it is just people not willing to mark down assets?
It started slowly, because people have been waiting for so long. It's starting. So can I tell you what we see?
Yes.
In our world, we lend money to people at 15% plus so they can hang on to assets longer. We go out and we buy assets, paying very little for the equity because they are so over-levered, and we de-lever them. And then we also convert debt into equity to kind of own the asset. That entire ecosystem opportunity set has just exploded in size. You know, if you look at somebody like us, we started out 3-4 years ago with a pipeline of $75 billion. We have a pipeline today of $365 billion. Right? And we invest $6 billion, $7 billion a year. So for us, you know, and when we say a pipeline of $365 billion, it's moving. People are starting to recognize the issues, and every one of those transactions.
Does this go beyond software? Like how widespread is this? Or are there any other industries that this phenomenon is concentrated in? Are there opportunities for you?
Danny, we've talked in the past. I know I can sound pretty brave. We have 0% exposure to software. When software goes bad, it just doesn't have cash flow go down 20%. It falls off a cliff.
But I would figure, Victor, like maybe there's some nice little juicy deals in there that maybe you want to get some because valuations have fallen enough. No, we're not there.
You know, the businesses which get into trouble in software, don't just get into little trouble, they fall off a cliff. So we've looked hard, we haven't done anything, and I bet you if we are talking a year from now again, I'll tell you, still done very little because the businesses which are in trouble are so damaged.
Well, where are the opportunities then you're finding? Any sectors in particular?
The real economy. For us, our focus over the last 10 years, 15 years, right? It is in buying into industrials, manufacturing, chemicals, consumer products. We buy a lot of real assets, power plants, airplanes, toll roads, right? That real economy is kind of our focus. And Danny, for us, all these problems in software or oil and gas shop, this stuff, you know, one tree does not fall in the forest all by itself, right? It reverberates through. Because the amount of capital available to do this stuff is shrinking so quickly, right? So the opportunity set in the real economy, it has just gotten so much better with these problems.
Is part of that also just because so much money is being funneled into AI data centers? Is there a kind of crowding out that you're seeing, that it's less competitive and you're seeing more opportunities in other parts of manufacturing because everyone's being distracted by this big shiny thing over here?
Yeah, it is. It's that. The data center, these guys are such voracious users of capital. Most firms now, they used to have private credit and CLOs and high yield. They've got a now special asset class called data centers, right? It just tells you the crowding out effect. I think it's a little bit more than that, though. You know, when you buy into these real economy assets or businesses, our view, you've got to fix them. They're broken. Some of the stuff which gets into trouble, good management teams are gone. You've got to often strengthen the management team. We bought assets like real estate, where leasing prices compared to the peers have dropped by 30%, and they shouldn't. So I think to our point of view, you need those skills to kind of actually work the asset. It's not just, hey, I'm buying a good asset cheap, right? And those skills are in short supply, right? So, and that to us is kind of, so the capital would like to do this, it just has trouble, those skills are in short
and
supply.
AI can't do that yet. AI can't turn around a company yet and hire the right management.
They can't get leasing in a property up by 30%.
And that's probably right. Victor, thank you so much for joining. Really great to see you. Francine, Victor Khosla of SVP.
A pleasure.
Danny, thank you. Danny Berger there in Berlin. Danny will have plenty more interviews throughout the day. Now, there's plenty more from SuperReturn, but in the meantime, we also really focus on Anthropic because the chief executive says AI will make the software industry larger, not smaller, although firms that don't adapt will disappear. Well, Dario Amodei spoke exclusively to Bloomberg Originals about how the company is working to align its business model with its values.
If you pick a business model that fundamentally conflicts with your values, you're going to have a hard time, right? Either you betray your own values or you become irrelevant. And so when we thought about it, we said, look, you know, we've seen the world of social media, the consumer world, it really seems to, you know, encourage engagement, even addiction, you know, the slop we've seen with AI video models. It's like, what's going on is it want to maximize the number of minutes that you're paying attention to because that's the advertising revenue driven incentive. Whereas if we look at enterprise, look, I mean, you know, we want to make these models useful to people. We want to use AI to, you know, cure diseases that we couldn't cure before, right? Well, that's working with biotech, it's working with pharma, it's working with academic research groups. All of those are enterprises, right? We want to use AI to, like, you know, to make energy cheaper and more efficient. That's all enterprise. And so I think it served us well to have this business model that largely aligns with our values.
Soon after Claude Cowork was released, $285 billion in market value vanished overnight. Traders called it the SaaSpocalypse.
This kind of white-collar wipeout story in the software sector, terrifying.
Some of those are down for 9 days in a row, so clearly the tension is building.
If AI continues improving at this pace, how much of traditional software gets replaced and how fast?
I think with AI, like the pie is getting bigger, right? So the existing incumbents may be smaller in relative terms. Some of them may go down in value. Some of them may even go out of business if they don't adapt in the right way. But like, I would guess that the software industry gets larger, not smaller, although there will be some big losers. Those who don't kind of see what's coming, who don't identify the moats they have, they're going to have a really hard time.
That was truly a fantastic conversation, and you can watch that full conversation on the new episode of The Circuit with Emily Chang. Subscribers can access it on the terminal, but also on Bloomberg.com from 1 p.m. UK time today. Now, coming up, quantum computing has the power to transform industries across the globe, but has yet to move from the lab to practical use. Well, our interview with the Chairman and Chief Executive Officer of IonQ is next, and this is Bloomberg.
Quantum foundry that we have committed will be open to all comers that are acceptable to the United States. So the 36 odd companies that are here, we are happy to give them our best technology, the same as we use for ourselves at that level, that they all get access to.
And you say all comers as to what's been approved. This is the idea that this is about furthering the U.S.'s aims to make sure that they have an advantage with regards to what gets made, and I would presume so that it doesn't get in the hands of the countries that we don't want it to have.
Well, I think that is easy. I mean, like, there have always been restrictions on advanced technologies that you cannot sell it or provide it to certain places. I think that is fine. But in a new area, it's really important to be first, both for the economic competitiveness long term, but also for national security. I think for those two reasons, it's imperative that we get there first.
Do you think the U.S. will be there first?
On quantum, absolutely.
You're not concerned about some of the reports that we've heard about some of the progress that we've already seen in China?
I'm paid to be paranoid, so I wouldn't say I'm not concerned. However, from everything I can see, I think we are ahead. Are we ahead by a decade? Probably not. But are we ahead by a couple of years? That would be my guess.
Well, that was Arvind Krishna, the IBM Chief Executive Officer, speaking with Romain Bostic about the future of quantum computing. Now, several large companies are racing to build working quantum computers, which they argue will transform finance, medicine, and, of course, cybersecurity. While some have demonstrated impressive advances recently, none have yet been able to demonstrate applications beyond research. Well, we're now joined by Niccolo de Masi, Chairman and Chief Executive Officer at IonQ. So, Niccolo, thank you so much for joining us. So this is exciting. We have a lot of research also that our Bloomberg Intelligence put together saying if you look at the funding of quantum computing overall, we're looking at $17 billion. Why was IonQ not part of the recent Commerce Department funding announcements? Did you do that intentionally?
Yeah, so we're actually buying another public company in the U.S. right now called Skywater. There's SEC rules about issuing equity when you're in the middle of a merger. We raised $3.5 billion last year, so we have tremendous access to the private capital markets. We were the first public company in our sector. We're the largest public company in the sector. We've been at it for 30 years. And so, you know, for sure, we always look at our capital needs, and we also, of course, are very active on the M&A front. We bought Oxford Ionics, here just a year ago for $1 billion.
So, I mean, the big question is when do we really see it in real practice? So where do you see and when do you see like real life application of quantum?
Well, IonQ demonstrated quantum advantage a number of times even a year ago on our 2024 machines. So we announced, a 20x speed up in computational drug design with AstraZeneca, NVIDIA, and Amazon. We've made progress with ANSYS and Synopsys on computational engineering. We announced over a year ago that we were able to help LLMs speed up and reduce their error rates while they're learning by putting one of our machines on the loop. So IonQ is a very different category, I think, than most companies that, you said a couple of minutes ago, people are in the research phase. We've moved out of the research phase. We're into the engineering, manufacturing, and scaling stage. It's why we're buying Skywater. It's why we bought Oxford Ionics. We started this industry 30 years ago. We're the first company that has published a shovel-ready blueprint of our full fault-tolerant system 6 weeks ago. And so we're really the point where we can throw money at this scale-up, if you will, to go faster, and that's very much where we are right now.
Niccolo, do you need others also to be successful so that investors really latch onto this? So on this program, we talk quite a lot about quantum computing. Not everybody does. So does it need to almost go more mainstream to have that, advantage?
Well, we were the first quantum company to reach 7 figures of revenue, 8 figures of revenue, and last year 9 figures of revenue. We very much, our ambition is to be the first to 10 figures of revenue. So it's becoming a real business. We were the first IPO in the sector in 2020. People used to ask me what quantum computing is 5 years ago. Today, your program speaks about it. And of course, governments are also realizing this is important for economic growth, national security, and of course, the jobs of the future. We've seen Prime Minister Starmer and Minister, Lord Valence, taking a great leadership position in the UK with programs such as their Procure and the National Quantum Computing Center. U.S., of course, is also running a DARPA, QBI, and other nations are realizing that resilience through quantum is very much an important national theme and opportunity. So I feel like it's going mainstream pretty quickly. I mean, people see tech trends and they can, envisage the future, and they want to capture that for their country and their company if they can.
So what does President Trump's funding of IBM actually mean for IonQ?
Oh, I think it's a great bet on both sides of the Atlantic on the growth, maturity, and opportunity for quantum leadership in the Western world, right? So our business is unique. We believe we're the leader in quantum computing and quantum security and quantum sensing, and we also have a merchant supplier function and product family that's important to IonQ. So we make the world's most accurate atomic clocks. We sell those to other quantum computing companies. Assuming our SkyWater transaction closes, over the summer, we will then have the largest merchant supplier function in the world. And so a lot of these companies are actually customers of ours. We're supporting their growth as well. So, investment IonQ is an investment on the industry, not just IonQ's individual path to computing, sensing, networking, and so on.
I know you mentioned the UK, but how much of your business actually comes outside of the US?
About a third. About a third. So we said about a third of our customers are international. About a third are buying more than one product from us across our quantum platform. And about 60% are commercial, is what we said on the last earnings call. So we're a business that has been, we've been first at everything. We turned our machines on in 2017. We've been doing useful things in the last 5 years. It becomes more powerful every generation of system. And of course, we were also the first to predict that the so-called Q-Day event was going to come, in the late 2020s, not the 2030s. And we're really making the future happen at IonQ with partnerships like Oxford Ionics, here in the UK. I was the only quantum CEO, the Technology Prosperity Act signing last September with Prime Minister Starmer and President Trump. So I think both nations recognize how special Oxford Ionics and IonQ are together. 1 + 1 = 30 is what I'm trying to achieve here for both nations.
So, Niccolo, Q-Day, for those that are less familiar with the term, is basically the day where a quantum machine breaks the RSA encryption. I think Google's prediction is that it comes as soon as 2029.
Yeah. So we said end of 28 last year.
Yep.
I think a number of companies, were still thinking this was 2033 last year. And we said, look, we published our roadmap last year on June 9th. And we said, we're going to be able to do it by the end of 28. By the end of this U.S. administration. I think, like with everything we've done at IonQ, we always lead the way, and other people then agree with us ultimately. And so, China's goal is 29, I believe, in their 5-year plan. I think Google agrees with us. I'll be unsurprised if soon the whole world agrees with us. But for sure, it's inside the planning cycle of CTOs, CEOs, and commercial companies, and governments also need to take notice of this.
How does quantum computing differ from, but also complement AI? And is there a bottleneck for acquiring talent?
Yeah, good question. So we're finding that the most successful adopters of our systems are the ones that are, of course, working with us on hybrid workflows.
Right.
So, you have a computer in front of you. The input machine is probably analog. You're calling a quantum computer. The output probably comes back to an analog computer. You need to have domain expertise, classical computing expertise, and quantum expertise. The intersection of those talent pools is certainly going to be, I think, some of the hottest jobs, in the coming years, and probably even, this century. I think the 21st century is going to be the quantum century, but starting, in the next year or two or three, you're going to see that intersection of those three talent pools and that Venn diagram is where the kind of $100 million AI engineers today are going to be generated. So we very much are speaking to, political leaders and, of course, commercial leaders about how we can work together to create those jobs. One of the most exciting things for IonQ is we're not a job disruptor, we're a job creator. There's no jobs that are going away because of quantum computing at IonQ. These are all brand new problems that currently take between a century and a millennium for a GPU data cluster to solve. We're trying to turn that into hours and days. So turning almost every impossible applied science problem for classic GPUs into a solvable problem. That means we're creating jobs, we're driving economic growth, and most importantly, we're keeping humans in charge. So there's no hallucinations. Yep. There's no correlation engine. I don't know about you, but I'm not using AI for my, my calendar because I can't afford hallucinations on, mistakes.
No one can afford hallucinations.
No one can, right? No one can. But quantum is old-fashioned computing. You're in charge. You design the algorithm. You tell the machine to run the algorithm. It doesn't go off and try and do something else.
Yeah, very reassuring. Niccolo, thank you so much for joining us. I hope this is one of many interviews to come. Niccolo de Masi, Chairman and Chief Executive Officer at IonQ. Now, there is a little bit of breaking news out of Iran. This is one of our biggest stories today. Iran is set to review the U.S. talks in light of the latest attacks. This is according to the state-supported IRNA news agency. Iran also saying that diplomacy does not happen in a vacuum. And this is a state-run IRNA agency citing the foreign ministry spokesperson. So we'll have plenty more on Iran throughout the day, of course, and we'll keep a very close eye on what's happening in the Middle East. Staying with tech, though, ASML's ascent to fresh record highs has boosted European markets, yet it's done little to improve what is the company's cheapest relative valuation in years. Now, while the Dutch firm's shares are up some 64% this year, the gain has lagged that of the broader U.S. semiconductor sector. So Sarah Jacob, our Amsterdam reporter, joins us now. Sarah, good morning. ASML up more than 60% this year. Its relative valuation is the cheapest in years. What exactly is going on?
Good morning. Yes, that's right. ASML stock has reached record highs. In fact, earlier this month, ASML became Europe's most valuable stock ever. And, just to remind, the viewers are watching, ASML is the only company that makes extreme ultraviolet lithography tools. These are machines that are necessary and crucial to make, advanced chips that power all these artificial intelligence applications. So we've seen the demand for their tools to be really high, the stock gaining still. Those gains have lagged its chip equipment peers, for instance, Applied Materials in the US, but also customers like Samsung Electronics. And a couple of reasons here. One of them, of course, is in terms of adoption of its next generation tools. Investors worry a little bit about the pace of that adoption. We heard from TSMC, its key customer, which said it would hold off on using ASML's or adopting ASML's high-NA tools through 2029. And there's also some concerns about supply and ASML's ability to capture this momentum.
Sarah, thank you so much for the great explanation. Sarah Jacobs in Amsterdam on ASML. Now, for more on the tech outlook here in Europe and London's role in the AI race, also check out our latest episode of Bloomberg Tech Europe with our Tom McKenzie. That's at 8:30 a.m. UK time this Friday.